Hi.
Ladies
Good
and
morning.
gentlemen. Hi. You want to go ahead, Hong now?
Yeah, sure. Thank you. Good morning,
All right.
everyone. Thank you for joining our analyst briefing with our CEO Piyush and CFO Sokhui. As we've just had slide presentations, we can go straight to Q&A. So, operator, can we please have the first question?
Ladies and gentlemen, we will now begin the question and answer session. Audio participants with questions to pose, please press 01 on your telephone keypad and you will be placed in the queue. To cancel the queue, please press 02. Once again, 01 on your telephone keypad now. Our first question is from Arkash, UBS. Please go ahead.
Hi, good morning. Thank you for taking the questions. And apologies, I think some of this might have been discussed in the media briefing, but we were on a peer bank's call, so we couldn't get a lot of that. The first question I have is just on the outlook for credit costs for this year and next year. I mean, given the lot more uncertainties that we have today on the growth side and geopolitical risks and everything. Do you think you still can go to a zero sort of level this year, close to zero level for this year, and then what about next year in credit costs?
So I addressed this in the media conference, right? So, if you think about the overall outlook, Ukraine and everything, then here's how I think about it. The first order impact on us is de minimis because we really have nothing in Russia, Ukraine, etc. So, it doesn't fundamentally change anything for us. The second order impact, I think of through the commodity complex, oil, gas, energy prices, metals, minerals, food, etc. And so that could create some idiosyncratic risk. You could have individual companies or corporations who are on the wrong side of some pricing bets or positions. So that could create some vulnerability. But I call it idiosyncratic. You can't sort of model for that. You can only sort of go back and look at your whole portfolio and see if anybody is impacted at a point in time. I'll come back to that. And then the third order impact is really the macroeconomic flow through. And that is something theoretically you should be able to model, but it's not easy. That's, what happens when inflation comes through, what is the impact on sales of companies? I mean, volumes might come off, prices might go up. What is the pass-through they can do in their pricing? What is the impact on their margins, etc.? So you can sort of put something, the debt servicing is likely to go up because of interest rate increases and so on. So that's something you can model and try and take a look at what might happen over the course of the next couple of years. But it's not that easy to be able to put that in the model, especially since nobody's really seen a high inflation environment in the world for a period of time, if you will. On the way we've been dealing with it is actually stress testing and doing bottoms up. So we've been doing a lot of stress tests across each of the obvious industry clusters, food and agri, metals, mining, energy complex, etc. We're doing a lot of stress tests around property, obviously, and we're doing a lot of stress tests around some of the consumer goods and trying to figure out, what pass-through mechanisms there, how much margin squeeze there might be. Based on that, in the short term, which is, I think, pretty confident for the course of this year, we are not seeing any material pickup in our cost of credit relative to what we normally assume, right? Our specific provisions, therefore. So in the past, I've said that we should be looking at specific provision guidance for DBS somewhere between 15-20 basis points range, and we're not seeing that materially change on the back of all the stress testing that we've done. On the zero allowances, that assumed that you would get SP number of around that level, and then because we built up so much general provision buffer in the last couple of years, we would start releasing the general provisions to match that SP requirement. So we'd come back to close to zero like last year. Whether we release the general provision buffer is something we'll be a little bit more thoughtful about in the course of the year. It really depends on whether the situation has better line of sight or not. At the same time, we expect the interest rate uplift to give us some unexpected tailwind. So even if we decide to hang on to the general provision buffer for longer, whatever we sort of lose by not releasing it, I think we will more than make up for that through interest rates in the course of this year. Now, when you look at the projection for next year, like I said, it's harder to model and figure what the impact on that next year might be. Our portfolio, like I said, is quite resilient. The biggest impact in a 2-year time frame is likely to be on the SME book. But our SME book has been really well stress tested over the last 6 years, mostly a secured book. And because all of these challenges, right from the supply chain from 2018-19, we've gone through 3-4 years of, I call it, trial by fire through the crucible. And so we really refreshed the book quite nicely. The building and construction, retail, wholesale trade. So my own anticipation that book will stay quite robust. But we will have to make a better assessment of it as the year unfolds. The other big thing is obviously consumer finance. Again, we don't have a very large consumer finance book, unsecured consumer finance book. But, and again, that's really the function of what happens to wages and what happens to debt servicing capability of the consumer. Again, something we get a better sense of towards the second half of the year when we're looking out for 2023. So because of those uncertainties and being difficult to model, the way our current inclination to deal with that is to be a little bit more careful before we release our GP buffers and allowances. We've got about over the time $1.8 billion out of GP that we built up outside of our models. And so we can be quite comfortable that our buffers are fairly solid.
Okay, understood. Thank you, Piyush, for that. The second question I have is on the trading gains, and it particularly looks surprising when other banks are reporting weakness and losses on that front. So can you explain what the difference is with DBS versus other banks? And you've also mentioned that higher market volatility is likely to help on this going forward. Could you just help us explain that as well? How does that work?
Actually, I'm surprised. I'm not sure what our peer banks reported, but if you look at the results of all the US banks and the European banks, everybody had a very strong FY22 quarter. So macro trading has done really well in this environment, and that's true for UBS. Just reported some massive results, mostly because of macro trading. So did all of the US banks, very strong macro trading. And we saw the same thing, that all of our debts, particularly rates did really well, but so did FX, so did credit, equities, all of the debts did well, because there's so much volatility in the market that if you position well into the volatility, you could make reasonable money. Now, I do think we are advantaged and helped because we have built up our flow business very nicely because of all our digital distribution over the last 2-3 years. So it is true that we sit on very good flows, and that gives us a greater advantage in terms of warehousing and positioning. But like I said, all of the globals also reported good results.
I see. And so I think from the MTM perspective, it probably, like you've said, it usually flew through the OCI channel directly and did not impact the P&L numbers.
Well, that's correct. So the negative that comes on the long bond book goes through the OCI channel. It doesn't come to the P&L. And again, you can see that in everybody's numbers. So all of the American...
Could you approve
Sorry. Hi, sorry, there's a cross line coming through. Could you mute, please?
Yeah, I was saying the OCI impact, again, you can see in the numbers of all the global banks, that the increase in interest rates means that your long bond position which you hold for investment, those get marked down. But that goes directly to equity. If you look at our own numbers, you can see it in the reduction in our shareholder funds for the quarter. But that doesn't come to the P&L.
Okay, cool. Great, thank you. The last question I have is on the staff cost pressure. And I mean, you guys are seeing a lot more pressure than peers year on year. So I'm just wondering, staff cost pressure. Staff cost.
Yeah.
So I'm just wondering, why is it more at DBS versus peers? What areas is this coming from? And keeping this in context, can you still meet your cost guidance, which is, I think, slightly higher compared to last year or the whole of this year?
Well, I haven't again looked at the peer staff cost, but I think we just want to check the market. Technology talent is very, very scarce across the region, and particularly in Singapore. The turnover rates for tech attrition rates are high across every market. I think it's also been exacerbated by the UK-Russia problem. Last somebody told me there were 300,000 engineers who were outside the market in Ukraine and another 1 billion in Belarus and Russia. So most of the big tech firms are busy hiring for tech talent in our part of the world. And so that is something that is flowing through everybody's numbers that I can see. But yes, when we given you a guidance for, cost increase slightly over last year, we've already factored into the fact that there is a flow-through impact of the wage increases we did last year, as well as what we are likely to have to do this year is there.
So it's mainly technology is what you're saying, not wealth management or other parts.
It's mostly the lift in technology. It's broad-based. We did salary justice last year were broad-based across the spectrum. But the turnover rates are the highest in tech, data, analytics, in all of those sectors.
Okay, got it. That's all my questions. Thank you so much.
Thank you. Our next question, Harsh Moody from JP Morgan. Please go ahead.
Hi, thanks for this. Couple of questions. One, Piyush, a technicality on NIM of 18 to 20 bip, or 18 to 20 million per bip. How does the near affect it? Is this adjusted for the near slope changes?
Yeah, so of course, if you look at our NIM impact, about half of it comes from the dollar book, not the Sing dollar book. So that, of course, doesn't get impacted by near or anything. That flows straight through. Today, about 94% of our dollar loan book is CASA funded. And it's mostly a floating rate book. So that all the upside goes straight to the bottom line. The other half of the impact which comes from the Sing dollar book, obviously that is impacted by the flow-through assumption from US dollar rates into Sing dollar rates. And there, if you look historically, when the Sing dollar is strengthening, the flow-through tends to be lower. When the Sing dollar is weakening, the flow-through tends to be higher. But on average, if you look through cycles, you tend to get roughly a 60% or so flow-through from US into Sing dollar. Right? So when we build our models, we take a flow-through assumption of where we see the Sing dollar going, where the Sing dollar will tighten, weaken, and we build that into our model. We also build into our model the likelihood of having to money outflow, paying up for liabilities, etc., etc. So we put all that in, and we take a fairly conservative view for what that might be. And all of that is sort of modeled and put into the number that we indicate to you.
Oh, okay. So then I should not. So basically, my presumption here is that you would assume, let's say, 60% pass through, let's say that holds. So I should not then further slice the 18 million further down.
Yes, you should not. You should not. I've already done that. I've already done that in the numbers.
Awesome. Okay. So that actually adds to what I was thinking the number would be. Thanks for that. The second thing, CT1 quite comfortable. What does it mean for payout ratios, buyback, evolution over the rest of the year?
Well, we've got this 0.4% impact from that operations penalty, and I don't know how long MAS is going to keep that. I have the last time they penalized us, it took us over a year for them to reverse it. So I'm going to keep an eye on that and see how long. I mean, we're on top of what needs to be done, but my own base case is that they'll keep that penalty in place for some period of time. So that's one thing I've got to keep an eye out on. The second thing I have to keep an eye on is if rates continue to go up, then we'll get more impact on our OCI, if we so, like everybody will, right? And so there'll be some pressure on capital that might come from that. So those are two things to keep an eye on. The third, so please remind me, go ahead.
Yeah, so the third thing is our Citi transaction. So we expect to complete it sometime after the sort of June next year. So that will add another 0.7 percentage point impact as well.
So when you put all of that together, we sort of balance it with the, obviously the capital accretion we get from our P&L. Now, obviously, if rates go up, we'll make a lot more money. So that will obviously be beneficial. So right now, we're not anticipating an unusual share buyback. Our current thing is to stick to our dividend policy, which is steady and incremental growth in dividends in keeping with our growth and profits.
Right. Okay. So what I'm coming to is, Piyush, even after everything, 14 seems like a pretty defensible number, assuming, let's say, the 0.4 comes back, let's say 12 months time, and then 0.7 goes out. So net net, you still are at least 100 bits above where your target is. So is it fair to assume payout ratios increasing, especially with rising rate environment, gives you that even if you provide a bit more, let's rather than 0, it is closer to 10 bits. There's still a lot more room to accumulate capital. So is it fair to assume that?
I think that's a fair statement that we have a lot of room. As you know, I never look and indicate a payout ratio. I've never done that so far. A dividend policy not based on ratio. If you work backward, you figure our ratio has been close to 50-55%. But I don't really do the payout ratio and then determine what dividend to pay. We try and figure out how much is the growth rate and the growth in our profitability, what we can use the money for, and then we work forward to see what is the appropriate dividend that we can pay out.
Okay, and the final question, Piyush, if I may. Lakshmi Vilas, Shenzhen Rural Commercial, Pathir, a lot of city now, a lot of stuff in the works. At what point in time do you see even more meaningful capital allocation to one or more of these businesses, and how do we think about P&L impact? Is it more a 23 or a 24 overall, the incremental delta both on capital and on bottom line? Thanks.
So, Harsh, I think the businesses where you see we are seeing impact and capital allocation are the ones we acquired in organic, this thing, those are chunky. So LBB is already, the integration is going really well. It's coming through quite smoothly, and over the next 2, 3, 4 years, we plan to continue to allocate more capital into India and grow the India book. I think that the last 2 years, India has already been outperforming, and on current trajectory, it'll continue to do well, but it will still need capital for the next 3, 4 years before it can generate its own capital. On Shenzhen Rural Commercial Bank, at this point in time, we don't need to deploy more capital. But if that, again, the bank is doing well, the business is doing well. So if there are capital calls over the next 2, 3 years, we put more capital in. It could be, if you look at, they brought us in as a shareholder at this point in time, prior to them going to the public markets, which is hopefully a 3-5 year event. So it is possible that the bank might need more capital, and then we look at it if that happens. But again, that's meaningfully accretive already, and you can again see that in our numbers. Maybe Sophie wants to comment on that.
Yeah, so currently we put the associate contribution under other income because it's not so material yet. So for this quarter, it's actually about 66 million. Versus 40 million in the last quarter. Because last quarter we had about 2 months impact. This quarter we have about 3 months impact. So it's not that small either, 66 million per quarter.
And then the third is the Citi Taiwan, which obviously will integrate only by summer next year. But again, that business starts throwing off, starts getting accretive and throwing off money very quickly, and it's also again quite meaningful in terms of size. Now, this is separate from the digital activity that we have. So if you look at the digital exchange or Pathir or Fix or even we started working on the software monetization, none of these require too much capital. So you don't have to allocate capital to those. As they scale up, we might have to start allocating some expense dollar and this thing to that. But these businesses, any one of them, is not going to show up materially in our numbers over the next 2, 3 years. It's a slow burn.
Got it. Thank you so much.
Thank you. Our next question, Nicholas Tay, Credit Suisse. Please go ahead.
Hi, thanks for taking my question. Just wanted to clarify on the credit cost guidance. I guess 15 to 20 bits in terms of SP would be the normalized run rate, and you're being more conservative on the GP write-backs because obviously the macro is quite uncertain. I guess when we do see that SP migration, there will automatically be some GP reversals. So is this kind of run rate of 5 bits of overall credit costs that we're seeing in the first quarter, I guess accurate to look at if barring any unforeseen circumstances, obviously.
Yeah. That's a good question. I hadn't thought too much. What is happening right now, Nicholas, you're correct. Because we've been conservative in our ratings and our models, as things are moving to SP, we are finding about almost 70% reversals from GP. Is that right? Okay,
but I think it's really depending on the case, depends on how fast we pick it up. But we have a good early warning tool. So I would say that in a good scenario, we should be able to release about half the SP from the GP that we have released.
Okay. So in the last quarter, so we released a large chunk, so let's call it half. On a good conservation, the half of it automatically comes from the models in the book, and the rest of it is incremental. So yeah, when we say 15-20 basis point SP, some of that will come from GP. Maybe half of it will come from GP in the natural course. Yeah.
Okay, thanks. And the second question I had is just, I remember, you were talking about monetizing some of your digital assets last year. Obviously, the market has changed quite a bit, but is there further details in terms of, which parts of that digital portfolio or platforms you have that you could look to monetize? And is this, after looking at it, is this something that doesn't look like it's possible in the near term given the markets?
Yeah, first of all, the intent of monetizing was never we will do it in 2022 kind of thing, right? So it is something that we can monetize. And you look at, I know in my head, think of it as three categories that we're exploring. One is businesses which are in the bank that we could potentially spin out. And the two which are most, the ones we're exploring the most, one is the payment business, the remit business, and the other is the large-scale democratized wealth business, the financial planning and wealth business. Both of those we still think have possibilities. We have teams who are working on that. Our real agenda though is to make sure that we have line of sight to EBITDA, cash flow, and how we scale those businesses if we do externalize them. So it's not a imminent activity, but yes, that continues to be a possibility. The second category is the businesses I spoke to Harsh about. The businesses we put some new business investments in the carbon exchange, the party of business, the digital exchange, the fixed income marketplace, etc. These I think are slow burn. I mean, I think each of these has got some possibilities, but there will be, like you mentioned, long lead time before they start scaling up to larger numbers. And the third category is we actually in the process of packaging and seeing if some of the technology that we build, we can monetize just by distributing the technology itself to other people. There's a lot of interest in our technology solutions, and that is something also that's got some legs. But it is unlikely, particularly given the market and the massive sell-off. I don't think you should expect to see any of that happening in the course of this year. And, even next year, we will judge whether there is real opportunity and when the timing is right.
Okay, great. Thanks a lot.
Thank you. We have our next question from Jayden, Macquarie. Please go ahead.
Hi. Thanks for doing the call. Apologies if this was covered on the media briefing. I wasn't able to make it. Just around the trends for wealth management, obviously there's been a slowdown, but can you provide any color on what you've seen in terms of assets under management, if you're still seeing inflows, and if we should still expect to see high single digits or 10% growth over the space of the full year? What's your latest views on the wealth franchise in particular?
Yeah, we did talk about it in the media call, but AUMs are up by about 3 billion. I think they went from 291 to 294 for the quarter. Net new money was also up. We got, I think, almost $3 billion of new money. So most of the AUM growth was new money. The rest of the portfolio sort of held flat. Overall, the wealth business, as we indicated, was down 20% from first quarter last year. But I think the first quarter last year was also an outside quarter. It was very, very strong. As we are going into the second quarter, I think we're tracking more at last year's level. It's not just a huge down, but we're also not seeing a big lift from last year. So if markets stay where they are, then we'll be challenged to get a lot of growth on a year-on-year comparison basis. Certainly, at this point in time, given the 20% drop in the first quarter, I don't see us getting double-digit growth for this year. Whether we eke out single-digit growth is a function of market sentiment in the balance of the year. Obviously, market sentiment recovers, which is principally the equity market, then obviously activity will come back. The only positive thing from that is that we have a lot of dry gunpowder. Like I said, AUMs are up, customers are up, and our non-invested monies in the AUMs are quite strong. So we do have a lot of, our customers have a lot of dry gunpowder, I should say. So if there is a turnaround in the sentiment, I can see the money being put to work quite quickly.
Okay, so it sounds like there's nothing structural. It's just short-term cyclical. Any sort of color you can provide on new customer acquisition or anything like that to sort of prove that it's still growing structurally?
Well, I can give you anecdotal stuff that there is obviously, as you can imagine, a lot of customer growth from North Asia into Singapore. And, part of it because obviously the COVID environment and so on. Frankly, in the last 2-3 years of COVID, we've had more than, 10,000, including the mass affluent, more than 10,000 new customers from North Asia. So it's been a consistent phenomenon over the last 2-3 years. And in some ways that continues to pick up steam.
Okay, great. Thanks a lot, Piyush. Appreciate it.
Thank you. Our next question is from Krishna Jeffries. Please go ahead.
Hi, thank you very much, Piyush. Just a couple of questions from my side. If you can give a bit more of color on your loan growth. I think you mentioned that a potential second half slowdown. If you can give because the street seems, at least investors I talk to, seems to be saying the second half will be better than first half with inflation coming down. But you mentioned that potentially a second half slowdown. So if you can give some color as to what you are seeing, and is it going to be a high probability event, or is it just something not to be worried about? That's my first question. The second question is on the fixed deposits. Are you seeing any shift to fixed deposits, especially for your US dollar liquidity? And the final bit is on the write back. Out of your general provisions that you have made, how much is related to oil and gas, or is it all already taken out? If you can answer that would be great.
Okay, Krishna. So on the first question on loan growth, on the corporate side of the business, I really don't have anything. If you look at our pipelines, it's quite robust. First quarter was 2%. Second quarter is also very strong. The pipelines are good. That's only predicated from a view of the macros. That while nobody knows that inflation comes down a lot in the second quarter, or the GDP growth rate reduction flows through in business activity or not. And because everybody is calling for much lower GDP growth into the second half of the year, it is possible and it's logical that should impact loan growth in the second half of the year. So what is my concept? Just being cautious that given overall what's happening to the GDP environment, loans might come off. One area on the corporate side where we benefited in the first quarter was trade. Trade went up by a couple of billion, and partly that's because of underlying prices. The volume of trade didn't change so much, but the value of trade went up because obviously oil, energy, everything went up. Now, if the prices start correcting in the second half of the year, that could reverse that trend. So that's the only thing to think about on the corporate side. The other challenge we have, which is why I'm guiding for slightly slower second half, is on the consumer, on the wealth side and the mortgage side. Our original agenda, our thought was that we'd be able to grow the mortgage book by $2 to $3, $4 billion this year. My revised outlook based on the December tightening the government did is I think we'll be lucky to get about $1 billion and change. So we're probably at least going to be short a couple of $1 billion in the mortgage book. And on wealth management, it really is linked to the first question. So part of our growth in the last year or two has come from margin financing. But if customers don't deal because the environment is not conducive and the confidence is low, then that impacts the margin financing book at the same time. So there are a lot of moving parts over here. Could we continue to get 2% growth a quarter? It's not impossible. But when you put all of the uncertainty, is it possible that you get a slowdown in the second half of the year? Yes, it's possible as well. That's what I'm guiding. Your second question on the fixed deposit shifts, actually we're not seeing anything right now, including in the US dollar book. I'm actually, as I said, quite encouraged that a large part of our CASA base, especially US dollar, is driven by transactional activity. It is all of the APIs and the cash management system put in place, and I keep reflecting that the underlying volume growth for us has been up 15-20% each year, 1 over 20 or in the last 2 years. We're getting that kind of growth. And so a large part of the CASA base, I'm hoping, is very sticky because they complete by transaction volumes. But no, so right now we're not seeing any shift. We're not even seeing a shift in Sing dollars. Of course, it will come. When rates go up, you will expect to see some shift, and that's what we modeled into our assumptions, but we're not seeing it yet. Your last question on the GP provision, we don't have anything particular related to oil and gas. The oil and gas portfolio is pretty much cleaned up. In fact, in the last year or so, we've been getting recoveries. So a couple of the chunky recoveries we've seen in the last year have all been from the oil and gas sector. We don't have anything specific for that sector at this point.
Just a last question. So oil and gas recovery, do you kind of get a sense of how much of idiosyncratic recovery can you have on that portfolio?
I don't think there's a lot for recovery in that portfolio either. I mean, the chunky ones which I was watching out for have flowed through. We see some. Every quarter we see some. Because we're very conservative when we dealt with that portfolio. So, as we're being able to get rid of some of the assets, the drill ships or the steamer, etc., we are seeing recoveries. But, no, there's no meaningful large recoveries that I'm anticipating now.
Okay. Thank you very much. Thank you.
Thank you. Our last question is from Melissa Kuang, Goldman Sachs. Please go ahead.
Hi, thanks for taking my question. Earlier, last quarter, you mentioned that your exit NIMs are looking like 1.58 to 1.6 based on 4 hikes. Given what we are seeing in terms of hikes this year, can you perhaps give us, if you have a revised guidance on this? And then the second question is just on your digibank Indonesia. And how it's doing. I mean, the digital banks, some of the digital banks in Indonesia are you also going to stay in that and push there? Thanks.
So on the, it all depends on how many rate hikes you assume, Melissa, and at what pace. The last, I saw some modeling based on 7 rate hikes, a couple of them front-loaded into May, is that we get full year NIM somewhere in the, what we told you was the exit NIM last time, around the 158 to 160 range. And exit NIM would be closer to the 180 range, is what I saw last. But like I said, you can come up with your own thing, depending on whether you put a 50 basis point hike in May and another 50 basis point hike in June, you figure out roughly. But I think order of magnitude, that's what you might want to look at. There's an exit NIM closer to 178, 180, and a full year average NIM closer to 158, 160 kind of levels. Your second question on digibank, we continue to grow our business. As I said, we've focused on making sure that we get good quality customers, and we are increasing the cash flow and trying to monetize the base. So we are not growing the digibank customer base just for customer acquisition. And that's been our strategy now for the last 2 years. It's a slow, steady growth. We still lose money. So our annual expenses, both in India and Indonesia, are not being covered by the revenues we're getting. But the revenue that we're getting is improving every year. And so we do have optimism that we should be able to break even on our cash flow revenue basis over the next few years.
Right. Thank you.
So, Melissa, just to be clear, the NIM guidance that we're talking about assumes that we have about 7, 8 rate hikes this year. When you ask the question, I think you're all it all depends on the number of rate hikes.
Yeah, just to underline, I mean, so I'd rather, you make your own assumptions on the rate hikes and see where we wind up at. When I said, saw this, I saw something internally which said that if we have 7, 8 rate hikes, this is what we were going up with.
Okay. And then maybe you answered this earlier, but maybe I just last question. In terms of the CET1, the drop from 14 point to 14, but then the dividend payment, was it due to the MES, the holdback on your capital, or was there some other things in terms of the CET1 drop?
So actually mix up 2, 3 things, maybe Sok Hui will give you some color on it.
Yeah, so the operational risk charge is at 0.4 percentage point. So you can think of it as that's the primary reason why it dropped from 14.4% to 14.0%. There are a few other drivers. I think you'll see most of the US banks also announced that there was an implementation of the standardized approach to counterparty risk rating. You look at our Pillar 3 disclosure, that's been quantified at 0.2 percentage point. The decline on fair value for OCI bonds, that was another 0.2 percentage point impact. But that was offset in this quarter because we also received the approval from the MES after working for 2 years on the advanced model for wealth models. So that gives us an improvement of 0.4 percentage point. So while these are the drivers, they actually offset to neutralize the effect of the SACCR, the FVOCI.
All right. Okay. Thank you. That's
it's in the Pillar 3 disclosure.
Thank you. We have now come to the end of the Q&A session. Ladies and gentlemen, this concludes today's conference call. Thank you for your participation. You may now disconnect.
Thank you, everyone. We'll speak to you next quarter.